Hello and welcome to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst for Warren Street Wealth Advisors. And today we're going to talk about tariffs. I know it's a topic you're just dying to know more about. My remarks today are taken primarily off the International Monetary Fund website from articles published in May, June, and July. And I highly recommend that you go there if you'd like to have more information on this topic. So here's the question we're trying to answer. Is the U.S. better off because of these tariffs? So we're going to start with looking at the aluminum and steel tariffs that were put into place in 2018 and what's the ramification of that to the extent we can evaluate it so far. So let's take a look at the chart on this left-hand side of the page. These horizontal lines are the time periods when the tariffs were implemented, when they were phased in. First there's 34 billion, then another 16, and finally 200 billion. The tariffs the U.S. put on China. And then as those tariffs go in, you can see how the value of the goods and services that are listed on each of these tariff documents has gone way down. So the U.S. is importing less from China, which is the point, right? Then as we look over on the right-hand side chart, China retaliates, and they're going to tariff goods that we export to them. So those tariffs go into place. Again, these are the U.S. lines, and then China retaliates, and all of these goods that China is tariffing also goes down. That we are importing less from China, which is what we intended, but we are also exporting less to China, which maybe wasn't exactly what the administration had in mind. What's been the impact on this so far, to the extent we can quantify it, is that the prices of these goods has gone up. So the chart on this side shows that the value of these goods, or the cost of these goods, has gone up, not a ton. The scale is pretty small here, 1.2, 1.15, 1.1. But on a global scale, that really is a lot of money. And those costs went up immediately as the tariffs were implemented. Who bears that cost? Well, it's mostly those importers who are paying the tariff costs if they still need to use goods provided by others. And those goods then are more expensive to those producers, who then have to apply those costs to us as consumers. If they're using steel to make washing machines or cars, ultimately the consumer is probably going to pay for that, and that's going to show up in inflation. The other thing that we've noticed is that businesses are resilient, they're adaptive. So as the imports and exports between the U.S. and China suffer, other countries come in to fill the gap. In particular with the U.S., it's Mexico. So now we're importing more goods from Mexico than we did before. So our overall net exports and imports has stayed about the same. Again, I'm not sure if that's exactly the intent of the tariffs, is that if you wanted to support domestic production, it's not quite happening the way maybe the administration would hope. You know who's really hurting from all of this, though? Are farmers. Because those retaliation that China put in place was particularly on soybeans, among other things. And U.S. exports of soybeans to China fell like a stone. And now we have these crops of soybeans that have nowhere to go. And so the price of U.S. soybeans also drops like a stone, and farmers are going out of business. The other side of that equation then is China still needs soybeans. Who are they getting it from? Well, their second producer in the past was Brazil. So Brazil sells more soybeans to China, but they can't just miraculously grow them on a dime so that there is a limited supply and the price goes up. So Brazilian soybean prices goes up and farmers are benefiting there. U.S. soybean prices fall like a rock, and U.S. soybean producers are suffering. So it's a global world where one person wins, somebody else is losing, and we can't always anticipate exactly how it's going to play out in advance. And the stock market is paying attention to this too. Companies that have significant exports are trailing the general index, which is what we've seen here as those imports or tariffs went into place. And then we thought maybe we were going to get some resolution. Those stock prices began to recover. And then we had more tariff talks in May, which scared people, and those prices fell again. So ultimately, the value of U.S. businesses is based on their ability to produce and sell their products and services. And that ability is hampered actually by these tariffs. What does the IMF think about all this? Well, global growth is still okay. They're forecasting the impact of these tariffs to be about 0.5% on global GDP. But overall, we see the global economy still okay, 3.2, 3.5 in 2020. Advanced economies are around 2. That's where we've been, down a little bit over the last few months. And emerging economies, though, are slowing. We were thinking that that's where the growth was going to come, but all of this trade tension makes businesses uncomfortable making long-term strategic investments, and that's hurting emerging economies in particular. So how much is it hurting? Well, you can see on this chart on the left the confidence effect and the direct effect and the market reaction, all of those added together. So in the long run, we'd expect to lose like this 0.3, 0.4% of GDP. In China, it's actually direct impact is bigger, because the impact of our tariffs on them is definitely meaningful to them. But overall, still that long-term impact, once we make adjustments with our supply chains, is about the same. So both U.S. and China actually lose in this scenario. Overall, this estimate of GDP growth over here goes down, like we say, about 0.3 to 0.5%, just because of the productivity loss to all of these trading partners because of the tariffs. So what's the key takeaways here? Tariffs seem to be like an easy way to implement domestic policies, but the backlash from those tariffs can be hard to anticipate, and you might get hurt a bit more than you're helped in the end. So what we recommend is to actually focus on those areas where you have a competitive advantage. That's where growth is going to come from, and deal fairly with our competitors or across borders where those areas of trade make sense to everybody else. So that's been a few minutes with Marcia. I hope you understand a little bit more about the impact of these tariffs, and I look forward to talking with you again soon.